Use to build a 15-minute video about how rising interest rates in Bank of Japan and the broader shift in Japan's monetary policy may influence the global economy over the next 12 to 18 months. Introduction. Why Japan matters. Japan is the world's third largest developed economy and a major participant in global financial markets. Wikipedia. For decades, the BOJ kept interest rates near or below zero and used aggressive monetary easing to fight deflation and stimulate growth. Wikipedia. But in 2024-2025, that changed. The BOJ began raising rates, ending the era of negative or ultra-low rates. CFI. Empower yourself. This pivot not only has domestic implications, it could reshape global capital flows, bond markets, exchange rates, and investment strategies. Today, let's explore how rising rates in Japan could influence the global economy next year. Number 1. What's happening in Japan? The rate hike story. As of late 2025, the BOJ's policy short-term interest rate stands at 0.5%, up from negative or near zero rates. TradingEconomics.com. Markets and many analysts expect further hikes, possibly to 0.75% or beyond, as inflation and wage pressures build. FX Street. Long-term yields are rising too. Yields on 10-year Japanese government bonds, JGBs, recently hit around 1.88 to 1.90%, the highest in nearly 2 decades. AM Invest. The BOJ appears to be following a gradual normalization path, avoiding a sharp spike while seeking to anchor inflation expectations. BOJ.or.jp. In short, Japan is exiting decades of ultra-loose monetary policy, reintroducing real borrowing costs and shifting financial conditions at home, with ripple effects abroad. Number 2. Direct global spillovers, capital flows, bond markets, and currencies. Reversal of carry trades and capital repatriation. For many years, investors borrowed cheaply in Japanese yen and used those funds to invest in higher-yielding assets abroad, a strategy known as the yen carry trade. Investopedia. As Japanese yields rise, that trade becomes less profitable. Investors may unwind carry trades, pulling capital out of foreign markets, e.g. U.S. treasuries or emerging market debt, and repatriating funds to Japan. That could reduce demand for foreign bonds and put upward pressure on global yields. Investopedia #yen appreciation and exchange rate shifts. As Japanese rates climb, the Japanese yen, JPY, is likely to strengthen against other currencies like USD. FX Street. A stronger yen might affect trade flows. Japanese exports become relatively more expensive abroad. At the same time, imports into Japan might become cheaper. This could ripple through global supply chains, trade balances, and export competitiveness. Global bond market impact and rising risk premiums. Higher yields on Japanese bonds and repatriated capital mean less demand for foreign bonds. That can cause yields elsewhere, US, Europe, emerging markets, to climb as investors demand higher returns. .com. This dynamic can raise global borrowing costs, dampen investment, and increase refinancing costs for sovereigns, corporations, and even households outside Japan. In effect, what's happening in Tokyo can shift global liquidity, risk perception, and investment flows across continents. 3. Impacts on global investment, risk appetite, and asset prices. Pressure on risk asset strategies. Risk-taking strategies funded through cheap yen are under pressure. As costs rise, the relative return of equities, emerging market debt, or high-yield corporate bonds may shrink, potentially reducing global risk appetite. With less easy money pushed into risk assets, we may see increased volatility in global stock markets, emerging economies, and maybe even real estate markets. Rebalancing portfolios. Less dependence on U.S. treasuries. Historically, investors from Japan have been large holders of U.S. treasuries or other foreign sovereign debt. Investopedia. With more attractive yields at home, Japanese institutions and pension funds might reduce foreign bond holdings, decreasing demand for global sovereign debt, pushing yields up, and raising global borrowing costs. Impact on emerging markets and global growth. Emerging markets, many reliant on foreign capital inflows, may suffer if those flows reverse. Higher global yields can raise borrowing costs for emerging economies, slow investment, and exacerbate currency pressures. Global growth could decelerate as capital becomes more expensive, and trade adjusts to currency exchange rate shifts and change demand patterns. Thus, Japan's rate moves may contribute to a broader tightening of global financial conditions, with possible ripple effects on growth, debt sustainability, and investment worldwide. Trade, exports, global supply chains, and inflation profiles. A stronger yen and tighter domestic conditions in Japan could slow Japanese export growth, affecting export-sensitive industries worldwide, especially those linked to Japanese supply chains, electronics, automobiles, parts, etc. On the import side, Japanese firms might source more abroad if the yen appreciates, shifting global demand patterns. In some commodity exporting countries or supply chain-linked economies, reduced Japanese demand could depress prices. Conversely, countries supplying inputs to Japanese import demand could benefit. Additionally, changes in exchange rates and capital flows could affect global trade balances, currency volatility, and inflation in import-dependent economies. Number 5. What's next? What to watch in 2026. Here are key factors and risks to monitor. Will the BOJ continue raising rates gradually, and how far? Some estimates place a terminal rate by 2026 at 1.5% or more. The Wall Street Journal. How will global investors respond? Repatriation of capital, unwind of carry trades, changes in demand for foreign bonds, equities. What will be the reaction in currency markets? A sustained stronger yen could reshape trade flows and global competitiveness. How will emerging markets and export-dependent economies cope with tighter global financial conditions, possibly weaker capital inflows, and higher debt servicing costs? Could global risk on assets, equities, high-yield bonds, emerging market debt see increased volatility or corrections? If multiple of these factors converge, 2026 could see a marked shift in global financial dynamics, with higher costs of capital, more volatile capital flows, and slower growth momentum, especially in debt-dependent or emerging economies. Conclusion. Why this matters for the world. The shift by the BOJ isn't just a domestic Japanese story. It signals a broader end to an era of ultra-cheap money that has helped drive carry trades, global liquidity surges, and capital flows for decades. As Japan unwinds those policies, the effects could ripple across global capital markets, exchange rates, trade, and growth trajectories worldwide. For investors, policymakers, and watchers of global macro, 2026 might feel like a new regime of tighter money, more expensive capital, and recalibrated risks. Understanding Japan's moves is therefore essential to anticipate where global finance and the broader economy may head next. If you like, I can prepare a full 15-minute